Hello, everyone. My name is David Gutierrez. I am the marketing coordinator here at Founders First Capital Partners. Again, welcome to our June broker webinar. Our webinar is Surviving and Thriving in a Capital-Scarce Environment, Tips and Tricks for Businesses and Brokers. In this webinar, we'll be exploring the challenges faced by multiple business founders and financial brokers in an environment where capital is scarce and where traditional financing options may be limited. We'll be providing you relevant and educational tips that will empower both business founders and financial brokers to navigate this capital scarce landscape successfully. Again, if you have any questions during our webinar, feel free to leave them in the chat, and then we'll have an opportunity for a Q&A at the end where we'll cover those questions as well. For today's webinar, we have two people from the Founders First team. We have Kush Kakaya, our Business Development Officer, and Oscar Franco, our Investment Manager here at Founders First Capital Partners. And they'll be going over all these tips and tricks that we have today for you guys. So without further ado, I'll pass it over to Kush and Oscar if they want to do any more introductions to kind of give backgrounds on their positions, and then we'll get started with the presentation.
Wonderful, wonderful. Thank you so much, David. Hi, everyone. My name is Kush Kakaya. I am the Business Development Officer here at Founders First Capital Partners. Been with Founders First for about 2.5, almost 3 years now. So I've definitely been around the block and definitely understand a lot about the types of businesses that we serve. And just to give you guys a little bit of a background on my experience and my background, I came from private wealth management. And then upon graduating university, joined Founders First. And really just looking forward to meeting as many new brokers and seeing what deals that we can work with. I'll pass it over to Oscar Franco.
Perfect. Thank you, Kush. Oscar Franco, investment manager here at Founders First Capital Partners. Been with the company. I'm getting closer to my second year anniversary in here. My main responsibility here is reviewing and assessing all the deals that come through our pipeline, right? So hopefully we get a chance to work together in the near future with any upcoming deals we may have. A little bit more about me. Prior to joining Founders First, essentially I've been working with entrepreneurs in the entrepreneurial ecosystem all my life. So 10 plus years working within incubators, accelerators, VCs, anything related to helping the entrepreneurs continue to grow their businesses, right? And excited to be here. And let's get started. So Coach, you want to take it away?
Wonderful, wonderful. So who are we? Who is Founders First Capital Partners? What do we do? Who do we serve? David, if you could go to the next slide. So essentially, Founders First, as Oscar had mentioned, we are a direct lender. And really what we are trying to do here at Founders First Capital Partners is really just try to solve some of the racial and socioeconomic gaps that a lot of underrepresented founders have been experiencing in this economy for decades now. And really just how we decided we would want to be able to help this mission and kind of prolong this mission is to be able to provide really amazing capital solutions along with also advisory services and also accelerator programs. So, as you guys can see on the left-hand side, we got a couple of statistics about some of the demographics and some of the people that we have served so far. And really just, we are continuing to provide mentorship through our accelerator programs, our different financing programs, and also advisory services. In terms of the clients that we specifically serve, we are actually, we focus primarily on B2B diverse-led businesses that have annual revenues anywhere between $500K to $10 million in annual revenue.
Perfect.
Pass it off to Oscar.
Thank you, Coach. Appreciate that. So diversify your funding sources. And can you go with the next slide, please? Next slide. There you go. So we always like to showcase this slide. I'm sure we'll see the vast majority of you are pretty familiar with sort of the funding landscape that is out there for entrepreneurs. But long story short, on the left side in here, you'll find your more, I would say, quote unquote, traditional loans, right? Your bank loans, your SBAs, which are Amazing, probably one of the cheapest, if not the cheapest type of capital out there for entrepreneurs. Unfortunately, the truth is not all entrepreneurs, especially the ones that we work with here at Founders First, qualify for it, right? Some of them are asset-based lender, maybe don't have any asset, or they didn't want to collateralize any personal assets into one of their loans. Maybe they're under the revenue milestone that they need to hit in order to become a little bit more appealing to the bank industry, so they don't qualify for it, right? Now, on the right side, there's your famous MCA loans, which are really easy to get. You can apply online for the vast majority of them. 24 hours, 48 hours to get the funding in your bank account. The truth is, once you analyze those terms, the interest rates are ridiculous, right? I had a chance to, as I said before, essentially work with the vast majority of the deals that come here at Founders First, and you'll see a lot of debt from 80% interest, 95% interest, which is crazy, especially with when you're essentially starting your company, right? There's a time and place for all types of funding. Don't get me wrong. A great example I always like to give is if you're on an e-commerce platform, you're sort of prepping, maybe a little bit short in inventory, you're preparing yourself for Cyber Monday, Black Friday, and you know that historically your sales during that period are whatever number. Maybe you just need some real quick cash just to storage a little bit more inventory in your company. Go on MCA, pick it up, go sell your product, repay it. It's really easy to do, right? It's pretty easy to get. Once it gets tricky, it's when companies try to make the strategic decisions based out of funding that they are getting out of MCAs, right? That's where you're starting seeing a lot of those stacking, getting another MCA to pay another MCA. And that's just a trickling effect that is obviously puts in the business in a very healthy position. Now, on the right side, it's your more, I'll say, equity plays. Let's put it this way. So angel investors, venture capital PEs, which are obviously a great source of funding, big amounts of money, especially for those entrepreneurs that are essentially expecting a very high growth. So tech adjacent, tech enable, to be more specific, SaaS, fintech companies, e-commerce, so companies that are expected to grow 10x, and that is very appealing for equity investors, right? Unfortunately, there's, like, again, a lot of the companies that we work here at Founders First don't necessarily qualify for that, so they kind of, that it's not even an option for them. So we always like to show cases slides with entrepreneurs just so they know that there's even multiple options out there for entrepreneurs, whether it's from more traditional loans or equity plays, revenue-based financing. It's also a great alternative for that, right? And that's essentially what we do here at Founders First. That is essentially our rockstar product, RBF, and we're going to go over that a little bit more later in this presentation. And just briefly, we like to position ourselves sort of in the middle of that. We have some equity components as part of the services that we can provide for entrepreneurs, but there's no dilution in any of our loans, right? So it's 100% a term loan. And the structure, if it's basically an RBF, it can be a little bit more flexible, especially for those companies that have a recurring revenue aspect to it and maybe some seasonality to the business. It could be a great source of funding. But we'll go over a little bit more deeper in how that works in the futures and not the upcoming slides. So let's go to the next tip real quick. And I'll pass it along to Kush.
Amazing. Thanks, Oscar. So for our next tip that we have is really just building strong relationships with lenders and other financial institutions. Seems very, very, very self-explanatory, but, there's a lot of different ways in which that you can connect with other lenders and other financial institutions. Some things that we do here at Founders First, really, for us to be able to engage our broker sides, is to be able to attend various different conferences that are in this industry. Two of the ones that we are very, very active in is the AACFB and NACLB conferences. I believe those happen 2 times a year. So I was actually there at the last AACFB conference in Irvine and last year's NACLB. And planning on continuing to do those. So hopefully I'll get to see you guys there. One of the things also that we really like to do and we really recommend is to schedule, regular recurring meetings and check-ins with, the lenders or the different, other brokers that you have and other partners that you have in your network. This just kind of keeps the cadence going, allows you guys to not only build up the relationship on a personal side, but also to be able to have that check-in so that you can go back to your team and say, hey, you know what, I have this regularly recurring meeting scheduled. And yet, we have this going every single week so that we can have at least some sort of potential deal flow coming in. Some of the stuff that we also like to do, as you guys know, there's a lot of different changes that happen in the banking industry. So keeping track of the criteria from various lenders is something that we really highly recommend, and really love seeing this from the partners that we have from our side, because it just shows that you guys are interested in learning what changes are happening on our ends. Additionally, also, sometimes we won't able to, not only us, but other lenders are not able to, provide loans to your companies and the clients that you service. So maybe just one of the things that we always recommend is seeing what types of networks that they have and seeing if you can get in contact with them. That's something that we do here at Founders First very regularly. If we're not able to move forward with a deal, provide a loan to a client, to one of your clients, we have multiple people within various different types of financing products, industries that we can be able to connect your clients to. And then also, I guess, lastly, is really just to explore different potential financing options, right? I'm sure you guys all work with such wonderful companies, but they also are very different. And for their growth needs, they'll be needing different types of financing offers and products. So being able to diversify that on your end and identifying which people could be good fits is something that we always really highly encourage. You can go to the next slide. That'd be lovely. To give you guys a little bit of an insight into our specific financing products that we offer, as Oscar has mentioned, we offer two different types. We offer our revenue-based financing, which is our bread and butter. And then we also offer just your typical term loan product. Now, for both of these products that we offer, on the left-hand side, you can kind of see the characteristics that we look for in a company that we like to fund. So as you guys can see, we like to deal with companies that are doing $1 million plus in annual revenue. That being said, I know in a previous slide we mentioned 500K. We do have certain states that where their lending requirements allow us to be able to provide loans to companies that are doing under $1 million in annual revenue. However, for the most part, I would say for most states that we work in, I would say the average is around $1 million to $10 million in annual revenue. Now, as we are a impact lender, one of the biggest things that we like to see is we like to see that diversity element whenever we're going through deals. So as you can see from here, these are the different types of qualifications that we have. So if any of your clients are women-owned, person of color owned, veteran-owned, LGBTQ plus owned, or even have committed to diverse and hiring practices, that's something that'll satisfy that requirement for our end. And then in terms of I would say the nitty-gritty business details and financial details, we ideally like to see companies that are profitable. However, we have done some work with companies and we have been able to provide loans to companies that are break even or have a very clear path to profitability. If you guys would like to learn more about that, please feel free to ask in the comment section below, or you can schedule some follow-on time with Oscar and myself to get a little bit more understanding as to exactly what we are looking for. And as we are, focused in on the B2B side of companies that we provide funding to, we like to see, a lot of recurring contracts or predictable revenue that we can track back in your historical financials. Lastly, we like to see companies that have been in business for at least 12 months. As Oscar has mentioned, because we do not collateralize any assets in the company that the company has or the founder has, how we secure our loans is really through the historical data that we are provided. Now, in terms of the specific products that we have, our ranges for both our revenue-based financing and term loan products, we can go as low as $50,000, and then we can go as high as $2 million, with the exception that the first tranche is capped at $1 million, and then we can provide follow-on funding up until that $2 million. And the biggest difference that we have between both of our products is with term loans, you'll have a fixed repayment schedule over the loan term. And with our revenue-based financing product, we have a specific royalty rate that we take every month. That's typically anywhere between 3 to 9% that we take from your client's monthly revenue to be able to pay off the loan. And now to go on the flip side, what some of the excluded industries that we have, as you guys can see from the bottom, is cannabis industry. This also goes to companies that work with cannabis companies or they're their main customers. We will not be able to provide funding to them due to our investor relations that we have. Anything that deals with weapons manufacturing, distribution, or sales, we're not allowed to do anything, or we can't provide any funds towards them. Anything in the gambling industry, so that would include casinos, online sports betting, And then with liquor, anything that revolves around liquor sales. So that would be restaurants, bars, nightclubs, other lounges. That's something that we cannot provide any funding to. And lastly, nonprofits. So with that being said, what we are really looking for in terms of, the types of businesses in our recent history, as of this year, we've been really focusing on SaaS companies or companies that are tech enabled or tech focused or provide some sort of technical solution. That's something that works well for us. And really, I would say at the end of it, what we are looking for is asset light, service based B2B businesses. That's kind of what we like to see. Obviously, if you guys have other clients or just have any people in your pipeline, we're more than happy to review them as they come along. I'll pass it off to Oscar.
Perfect. Thank you, Kush. So tip number 3, know your clients and their financials. And can we go to the next slide? And this is just essentially me talking based on my experience as well, and some of the things that I'm seeing that I had the opportunity to see here at Founders First. So one, I'll say some of the biggest obstacles is trying to obtain the right set of documents. And what I mean right is also that they're accurate and in the right formats that we need. And at the same time, how they can articulate not only their business model, but their growth plan for the future, right? So going into tip number 1, we'll say I'll definitely recommend your clients before they go into a meeting with any potential lender or Founders First to be prepared for that type of questions, right? So one of the things that really set us apart is that in comparison to other lenders out there, they might be a little bit more interested in bank statements, maybe how much money is coming in, how much money is coming out of the business, or just your debt situation and your debt structure, and maybe that's it. Maybe that they can make a decision out of that. At least for Founders First, we really need to take our process a little bit more deeper, right? We want to understand the business model behind. We want to understand the strategy, the future strategy. What is the market potential out of this business? What is the use of funds that the company has, so to be mine to use some of our funding. Those are some of the questions that we ask the entrepreneurs during our one-on-one meetings with them, right? So being prepared for that is something that I will definitely recommend always for entrepreneurs. And also if the broker has that information, even better, right? Because we can go over that in a very initial conversation. We don't necessarily have to wait until we get a chance to connect with the founder. Number 2, having an updated and a full package of financial documents. Like I said before, I'm sure there's a lot of lenders out there that maybe with some minimum requirements or minimum documents they can make other decisions. Fortunately for Founders First and our internal process, we need to require a little bit more of that. So we can go over, we're going to go over that in some of the later slides about the specific documents that we need, but we really need those because we really want to understand the business model, right? And we want to make sure that as an impact lender, if there's any upcoming potential money or funding that we can add to the entrepreneur, it will be in a positive way and not be detrimental to the company's growth, right? So we really need to take all of those things into consideration in order for us to make a decision. And number 3, also as a great resource for all of you, for some of your clients that might be a great fit for what we do, but maybe need a little bit more help on their financials, there's some other resources that we can offer here at Founders First. So we have a great partner, Terra Business Solutions, CPA experts, who will have essentially an assessment and a financial readiness plans that we can give up for free to some of your clients. Again, especially those that are a good fit, that might be just a little bit of help with their financials in order to prep and have all the documents ready for our review, right? So this is just, again, an extra layer or an extra addition of the services that Founders First is willing to offer to work with your clients as well. Let's go into the next tip real quick. So leveraging the power of technology. Again, there's a lot of great technology out there right now that is really accessible for entrepreneurs. And there's obviously multiple vendors. This is not a commercial, so feel free to, I will always recommend your clients to do a bit more research. But as far as the main tools out there that we have seen that are very beneficial for entrepreneurs, I would say number 1, QuickBooks Online, right? Thankfully, less and less now. I still get some essentially financial statements that were created in an Excel sheet, right? Now I'm starting to see a little bit more professional, specifically QuickBooks Online. It seems like the most common platform that companies are using. Those are great. You know, the accuracy of the financials are going to be great. The reporting on those, how easy it is to get the information. We have an API here internally, Codat, where we can sync their financials and we can get view access and download the reports as much as we need. And it takes 5 minutes to do it, right? But you'll need QuickBooks Online in order for you to do that. So QuickBooks Online obviously is a great tool that entrepreneurs definitely need to leverage it on. Automating email campaigns. So we use obviously different tools here internally. HubSpot is another great one, especially for anything related to sales. And having those automated emails to continue to do not only upselling, but send reminders. There's a lot of things your clients can take advantage of that, right? So that's another thing. CRMs, here internally, we use one CRM. There's multiple out there, but again, as far as data collection, reporting, tracking, to keep a perfect tracking of your KPIs, your weekly meetings, monthly meetings, results, obviously having a CRM makes things way easier, right? And of course, there's very complex CRM out there, but there are also relatively cheap versions of it. So we will always encourage entrepreneurs to start leveraging on those. ChatGPT, right? So I know a lot of you are now familiar with ChatGPT. I personally use it all the time, and it is a great tool for not only marketing purposes, follow-up emails. It saves a lot of time, great information. You'll get essentially pretty precise depending on the input that you put into those things, but there's definitely some things that just saves you some time, right? And it can help you focus a little bit more on some of the things that are a little bit more time consuming. So those are just some of the resources that we always encourage entrepreneurs to at least start using or getting familiar with it. And especially once you start automating those things, like I said before, it gives you some time to start focusing on maybe some other things that need a little bit more attention. So let's start leveraging our technology for that. Now let's go over to the next one, and I'll let Kush take this one.
Awesome. Thanks, Oscar. So to give you guys a little bit of a insight into, some of the documents that we need in order for us to be able to process some of these loans. Typically what our underwriting team has given us, has told us to do and told us to collect is 2 years worth of financial statements broken down by month in Excel. So this will include your balance sheet, your client's balance sheet, cash flows, and P&Ls. And as Oscar has mentioned earlier, we actually do have an integration with Codat and Plaid to be able to sync your client's QuickBooks Online account and all the information from there. However, with that, if that's something that we are able to, if that's the way that we're going to be able to collect your client's information, we will have to have the cash flows exported from that. It's just due to some technical issues that is on the Codat side, where we have to actually gather the cash flows manually from there. Next, we look for 12 months of revenue by customer by month. And really what this does for us, as I've mentioned before, because we do not collateralize any of the assets, what we are trying to do is we're trying to get the full holistic sense of your client's financials. And what this document provides us and what it gives us an insight in is the customer concentration and the strength of the recurring revenue that the client has. And so this is something that's very important for our underwriting team to be able to do. If your clients have any issues or have any questions with regards to filling out these informations, I'm more than happy to get on a call with you and the client to be able to work you guys through any issues that you guys are having. Lastly, we'll need a debt schedule. And any projections is greatly appreciated, and we love to see what calculations and what projections your clients have been able to come up for themselves. And then also for any companies that have any independent investors or who have relinquished any equity, a cap table will be something throughout our due diligence process that we will be looking for, but that'll be a case-by-case process. As I mentioned, right, we do have this Codat API sync that we are able to do. So if you guys would like to have more information on that, I'm more than happy to send over a QuickBooks Online guide that our underwriting team has created to help you and your clients guide through the process.
Right. Just quickly out of that, just because it recently happened with a broker, as Kush mentioned, right, projections are a great thing to have. They're nice to have, but it's not a requirement to start the process, right? So the only reason I share this because I was working with a broker, and they were sort of taking a little bit longer to send the information, and I found out that they were working on the projections, right? So if you don't have the projection or your client doesn't have the projections, you can go ahead and start with the other documents first, and once you have them, feel free to send them. Of course, those projections are really helpful, especially to understand the potential upcoming revenue of the business. So I just wanted to make that announcement real quick. I think it's important. Perfect. Now, tip number 5. So maximize your capital efficiency. And for that, I think the best way to do it is just, especially to showcase some of the benefits of working with RBF and some of the benefits that obviously can translate into your clients, right? Number one is a limited financial covenant. So the payments will depend solely on the company's performance, and especially for RBF. So as Coach mentioned, right, there's a royalty fee. So if the revenues of the company are going higher, you're going to pay a little bit more on your debt. If the company maybe has some seasonality, or maybe there's some slower quarters, you're gonna pay a little bit less. So we're in it in the risk with you guys as well. No loss of control. Again, just sharing an example. I was at a graduation ceremony of a big accelerator in the San Jose area. When I was talking about revenue-based financing with some of the attendees, no equity component and no losing control of the business was huge for them, right? Especially those that have traditionally have gone into the equity place. They understand not only how time consuming it is, how long it can take. And also, to be honest, they don't want to continue to give out equity of their business, right? So if they can qualify for some alternative options to continue to fund their business, or it can integrate those into their capital stacking, it was huge for them, right? So no loss of control, no pledge of specific assets, as Coach mentioned. We don't ask for any founders' personal assets, right? So we're not going after their house or anything like that. Aligned interest. So our IRR, depends on your performance. Again, it's very aligned with the company's performance as well. Advice, and Coach mentioned this in the beginning. So we don't not only have the nonprofit side and the accelerator programs in there, which, by the way, can be simultaneously. You can start applying for one of our loans in the same time that you're doing one of our programs. If you're interested in that, 100%, your clients can definitely do it. But also we have expansion services as well that we can offer for those of the funding companies that we end up working with, right? So those are essentially monthly calls, KPI reviews. Our founder and some of the amazing coaches and advisors that we have here at Founders First are very seasoned entrepreneurs, so they can get access to that as well. And just lastly, for those companies that have a potential exit at some point during their trajectory on their lifeline, retaining some equity will, of course, would be beneficial for them once they reach that potential exit, right? Because they will have more ownership of as far as equity in their play. So absolutely, for those companies that also have a potential exit strategy at some point, RBF could be a great resource for them. And for that, and I think we always like to go to some very specific examples, right, of how whether it's our terminals or RBF works. I'm going to pass it along to Kush. He's going to walk you through some examples.
Thanks, Oscar. First, we're going to go through our revenue-based financing example that we have. So as I mentioned before, there is somewhat of a royalty rate that is taken out from the client's MRR in order to be able to pay off the loan. So typically, how we are able to calculate that MRR is by and calculate the full repayment of the loan is specifically for revenue-based financing is to attach a loan multiple to the loan to the principal that you have. Typically, where we kind of fall in this range is anywhere between 1.2 times the principal or 1.4 times. And that really, I mean, we can go a lot more into the weeds into how we actually are able to calculate that term. But for us to, for the sake of simplicity, we'll just go right down the middle. So 1.3 times for the multiple. And if you guys look to the left-hand side, you'll see that there's a company that's doing around $1 million in annual revenue. They were approved and are seeking $200K at a term length of 3 years. And so typically, for this, it'll be anywhere between 2 to 5% of their monthly revenue to be able to repay the revenue. And one of the biggest things that I would say a lot of people really just love about our program is that, and our products that we have, is there's zero penalties that you will be paying if you pay off the loan early. Now, oftentimes at a lot of other lenders, this is something that happens often. And so what we decided to do is really just go about it in more of an incentive approach rather than a penalty approach. We've had this happen with a lot of our loans where they've actually paid it off, a year prior to when their loan maturity date was, and this was and then they actually came back to us for follow-on funding. So this just kind of allows us to give them a little bit more flexibility. Similarly, on the flip side, if there's something that happens, we all recognize that there's unforeseen circumstances that happen and that could alter the performance of the business. We're very, very flexible in trying to extend out the runway that you have for this loan, or extending the term length, or being able to restructure it. That's something that our underwriting team can definitely do and work with your clients on. If you could go to the next slide, that would be lovely. So, for our next financing product that we have, it is our term loan. As I mentioned, it is a very, very simple term loan that we have. So that means that there is a set interest rate along with also set monthly payments that are happening. So let's just say for the exact same type of business that's doing $1 million in annual revenue, and we're given $200K in annual for the principal, their total repayment will be $260K, and the fixed payment will be $7,222 per month for the duration of the 3-year term. And so these are just really kind of the two different types of offerings that we have. One of the things that a lot of people come to us for is, they're trying to do some sort of capital stack. That's something that we work with and really, really well, not only with other forms of alternative debt, but also with equity. So this is something that we can assume a second position for. Oftentimes, a lot of people also come to us specifically for the term loans, for the term loan products, to be able to refinance any, unfavorable debt that they have, whether or not it's MCA or just really high interest debt. This is something that a lot of people have really, really enjoyed about our products, to be able to pay that down and get a much lower rate. You can go to the next slide. And I believe that this is the end of our presentation that we have. Are there any questions that we can answer for you guys?
Nice. So we did get 2 questions in the chat. We'll start off with the first question. How quickly do you make a decision after receiving financials from a company?
That's a great question. So there's 2 sides of the story, right? So to answer your question, long story short, we'll say 3 to 4 weeks. That's usually how fast we can move. However, it will depend a lot also with your client and how fast they can not only get the documents for us. We may have some questions related to the financials or some of the additional documents that we may need. It will depend on how fast that communication also is established with your client. But long story short, we can go up to as fast as 3 or 4 weeks.
Already perfect. And then we also have one more additional question that came in. The question is, do you work with companies that don't have any recurring revenue?
Yeah, so the recurring revenue aspect, it's going to be very important, specifically for the RBS types loans. So term loans, we can be a little bit more flexible. Obviously, recurring revenue, it's one of the main criteria that we take into consideration. However, we can be a little bit more flexible with maybe companies that are work project-based, companies that are profitable, companies that can showcase that they have some long-lasting relationships with their clients, regardless if they have any contracts with them. So we can be a little bit more flexible to that. However, when we look at a potential deal for an RBF perspective, recurring revenue, it's 100% a must, right? So term loans is where we can be a little bit more flexible in that sense. Hopefully I answer your question with that.
Alrighty, perfect. I believe those are the questions that we received from the chat itself. So, are you ready to work with Founders First Capital Partners? If you are, you can work with our team. We have the contact information for both Kush and Oscar on the screen. You can jot that down really quickly, but we'll also be sending out these slides to all the participants who came. So make sure to look out for that. Just get all the tips that we presented today and also the contact information if you do have any sort of deals or just want to learn more about Founders First and our mission. And below is also our website.
Sorry to
And
interrupt,
finally,
but we had
you.
a last minute question.
Okay.
Question, Oscar, do you lend B2C?
Yeah, so B2C is gonna be a tough model for us, especially because of the recurring revenue aspects. Historically, B2C has been a little bit more transactional for us. And that's just based on historical information we've seen for some of the deals recently. However, I never want to say no 100%, right? So to that question and to the previous questions, if you have any company that you're not necessarily sure if they're a fit or not, go ahead and send us an email. Send us an email. Hey, Oscar, I have this client. This is their business model. Do you think they're a fit or not? Before we send any documents, I just want to verify if they are a good fit or not. You can send it over. We can chat about it. So I'm always open to the idea for that.
Okay, and then we had another last minute question. What is your ideal customer for a 3 to 4 week turnaround?
Great question. I would say a SaaS company, software as a service, recurring revenue, tech enable, some decent amount of funding in the business, maybe minimum debt. If they're profitable, even better. If they're not profitable, a pretty decent burn rate and runway. That will be an ideal candidate for a 3 to 4 week turnaround for sure. And like I said before, having that very flexible and agile communication with your client so we can move forward really quickly.
Alrighty, perfect. Again, thank you all for those additional questions, and hopefully they give you more clarification on our financial products and what Founders First Capital Partners can provide for you. Again, we'll be sending out the presentation to all the participants shortly, so you can just get a recap of all the tips and tricks for a capital scarce environment. I just want to give one big thank you to our guest speakers, or our guest speakers from our team, Kush Kakai and Oscar Franco. Their information will be in the slides as well, so if you have any additional questions or want to learn more, you can reach out to them. But other than that, thank you again for attending our June broker webinar. This is a continuous series, so we'll be having one in July and for the rest of the year. So we look forward to seeing you then. Thank you.
Thank you for joining.
Thanks, everyone.